Hi, 8,000 years ago, Mesopotamians came up with an idea of barter system. Under this system, people could exchange one thing for another, like apple for orange, salt for sugar, or anything else. This system enabled people to own things which they don't have, while simultaneously getting rid of the things which they don't want. However, it was very inefficient. You will have to not only find a person who has the stuff that you want, but also the person who wants your stuff in exchange. This problem was solved by King Anytus around 2600 years ago in Lydia, which is now a part of Turkey. He created the first known currency, and thus the concept of money came into existence. Before we move on, don't forget to smash the like button and subscribe to Funvestor. Today, almost every country has a currency of its own. There are a few countries like Ecuador and Micronesia which do not have their own currency, while others like Cuba uses multiple currencies simultaneously. Apart from these exceptions, almost every country has a currency of its own. Even after money was created, little that we knew, we will have to again come back to the barter system. How? Let's take an example to understand this. Imagine America has apples while India has grapes. Now, India wants apples while America needs grapes. So they both decided that America will give one apple for every 70 grapes to India, and they both agreed. This seems like a barter deal, right? Now replace the apple with US dollar while grape with Indian rupee, and we have a barter exchange, which in financial terms is called foreign exchange or forex. The market where such exchanges are traded, that is one currency for another, is called forex market, which is also the largest and most liquid investment market in the world, trading trillions of dollars every day. Here, 70 grapes for one apple is the exchange rate, which keeps on changing almost every moment and depends on several national and international factors. That's how we get the figure of $1 equals 60 rupees or 70 rupees. This USD INR pair is called currency pair. So if USD INR is 74, it means 1 US dollar equals 74 rupees, and people trade forex on the possibility of this exchange rate going up or down. Any two currencies can be exchanged as per the legal regulations in the forex market. This market has no centralized location and is traded globally via electronic networks. The trading happens 24 hours and is closed only between Friday evening to Sunday evening. But why do countries keep forex reserves? There could be several reasons, but let's look at a few. Suppose India wants to import Tesla cars from US, but what would Elon Musk do with the Indian rupee? He cannot use the Indian rupee to buy things in US or pay taxes there. So India needs to exchange its rupee with US dollar first and then pay Tesla in US dollar terms. Let's take another example. Suppose your friend is in US and needs $100,000 for some project. You are living in India, agreed to lend this money to your friend, but you have money in rupees and your friend needs dollars. So in order to facilitate this transaction, you will pay Indian rupee equivalent to $100,000, which will be calculated basis the exchange rate during that time. There are some other factors as well, like stabilization of rupee or economy as a whole, but let's park it for some other time. This was the basics of forex market, and we will cover more advanced topics in subsequent videos. Till then, I have already made a few videos on basics of finance and stock market. I highly recommend you should check out those other videos as well. They are fun, easy to understand, and extremely informative. Hope you loved this video, and if you did, smash the like button, subscribe to Funvestor, and hit the bell notification so that you know when we upload a new video. Till then, thank you and see you next time.